Welcome to This Explainer. Today, we're unpacking a truly phenomenal story of resilience, financial grit, and the raw power of transformation. If you've ever wondered how some of the absolute titans in the financial world actually got to where they are, well, you're in exactly the right place. We're going to trace the ascent of Vishnu, following his journey from the chaotic energy of Delaw Street all the way to becoming India's premier venture capitalist. But listen, this isn't just your standard story about making money. It is a masterclass in how failure, when you handle it right, actually compounds into massive, undeniable success. Okay, let's dive into this. Today, Vishnu stands at the helm of Agastya Ventures, which is quite literally a multi-billion-dollar venture capital powerhouse. We're talking about a firm that has backed over a dozen tech unicorns and hundreds of high-growth startups all across India. I mean, they're the market makers, right? The kingmakers of the modern Indian economy. When Agastya writes a check, the entire industry turns its head. But how do you actually build an empire of that magnitude? Do you just start with a massive trust fund or some flawless track record? Well, not exactly. Because before the billions, there was a 16-year-old boy staring at a 60% loss on a 5,000 rupees childhood savings account. Think about that for a second. This young kid had painstakingly saved up all his festival gifts, money from odd tutoring jobs, basically the whole shebang, and he took all of it, completely captivated by these daily stock market updates he hear on the radio, and he gambled it on a hyped-up TV stock tip. Within just 2 weeks, bad news hit the company, the stock absolutely tanked, and poof, the vast majority of his hard-earned savings just evaporated. It was a crushing blow, the kind that would have driven most teenagers away from finance for the rest of their lives.
But then came a really pivotal moment. He was expecting a harsh lecture from his father, a humble accountant who'd spend his evenings balancing household ledgers into this flickering ceiling fan. But instead, Vishnu was handed a blank notebook. His father looked at him and said, "Losses are just tuition fees for the smart. Write down what you got wrong." That profound little piece of advice completely reframed failure for Vishnu. It wasn't a dead end anymore. It was a learning opportunity. It forced him to realize he had essentially gambled on pure hype. From that day on, he ditched the TV tips entirely and dove headfirst into fundamental analysis, reading actual annual reports and studying real profit margins. So, his career progressed through 4 main phases, starting with those childhood ledgers, then moving into investment banking, through private equity, and finally landing in venture capital.
Chapter 1: The Investment Banking Crucible. Right after business school, Vishnu deliberately chose the insanely intense, hyper-competitive world of investment banking in Mumbai. In IB, your job is helping massive companies raise huge amounts of capital or execute these really complex corporate mergers. The stakes are just astronomically high. I mean, on his very first day, his boss made it crystal clear. In this environment, a single wrong formula in an Excel spreadsheet could cost a client 50 crore rupees. Precision wasn't just some nice-to-have trait. It was literally the baseline for survival. Over 3 grueling years of 100-hour work weeks, Vishnu mastered 3 core precision-based skills. First, financial modeling, building out these incredibly complex Excel models to calculate what a giant corporation is truly worth. Second, valuation, developing the sharp eye needed to spot whether a company is vastly overpriced or actually a hidden bargain. And third, deal structuring, learning the intricate nuts and bolts of how multi-million-dollar corporate mergers actually happen in the real world. These skills completely forged his financial discipline.
But as he was sitting there structuring these colossal deals, he noticed this massive strategic juxtaposition. On one hand, you had these giant corporate clients with tons of capital, but they moved so incredibly slowly. On the other hand, out in the real world, young tech startups were growing at lightning speed. They were rapidly changing how everyday Indians paid their bills, how they shopped, and how they traveled. Vishnu realized the real future wasn't just in moving money around for the slow giants. It was in fueling these fast-moving innovators. Chapter 2: The Private Equity Trap. Eager to learn how to actually grow businesses from the inside out, Vishnu pivoted. You see, unlike IB, where you're just advising, in private equity, you buy a massive stake in a company. You roll up your sleeves, you optimize the operations, and you sell it years later for a profit. It is a highly hands-on approach to business optimization. And this is exactly where Vishnu faced his second devastating failure. Eager to make a mark, he led a multi-core investment into a traditional retail chain. On paper, absolutely flawless. High revenues, cheap valuation, a massive physical footprint. It literally checked every single box his strict investment banking training had taught him to look for. But just 6 months after the deal closed, a massive e-commerce wave swept through India. Consumers shifted to online shopping almost overnight. The physical retail chain's sales absolutely plummeted, and Vishnu's firm took a heavy, very painful loss. And this brilliantly illustrates the core lesson of his time in private equity. In the post-mortem meeting for that deal, Vishnu stood right up and owned his mistake completely. He realized he had looked strictly at historical balance sheets and completely missed the massive technological shift happening right outside his window. So the takeaway here is crucial. A profitable business with an obsolete technological model is a financial trap. Past profits matter, for sure, but future relevance matters so much more. Chapter 3: Building a VC Powerhouse. By the mid-2010s, cheap mobile data and UPI were completely transforming India. So Vishnu took a bold leap, pulled his own savings, and launched his own fund. While private equity requires betting on proven numbers, venture capital is a totally different game. It's all about betting early on unproven but visionary founders. It's about funding people who are building out-of-the-box solutions for a country that is rapidly changing right beneath their feet. You have to see a future that doesn't even exist yet and have the guts to fund it.
Now, institutional investors were pretty hesitant at first to give their capital to a young manager. But Vishnu brought this unique three-pronged edge to Indian VC. First, founder empathy. Because he had faced his own high-profile failures, he actually supported founders through their darkest times, instead of just firing them the second things got tough. Second, financial discipline. Thanks to his hardcore IB and PE background, he never bought into fake hype. He demanded real, sustainable unit economics. And third, a grassroots focus on Bharat. He looked right past the shiny city startups and invested in regional fintech, affordable healthcare, and rural logistics.
And the results of that edge? Absolutely staggering. His battle-tested judgment paid off in a massive way. One of his early investments was in this relatively unknown regional agritech platform focused on helping millions of everyday farmers. That single grassroots investment returned a phenomenal 40 times the invested capital back to his fund. To put that in perspective, that's a grand slam in the VC world. He wasn't just predicting the future anymore. He was actively funding the foundational architecture of the new Indian economy.
Chapter 4: The Ultimate Compounding Asset. So we've traced this incredible journey from a modest apartment with a young boy reading ledgers all the way to a global economic forum stage. When asked on that stage how a middle-class kid who lost his first 5,000 rupees became one of the most influential investors in the country, Vishnu shared this really powerful insight. He said, "My losses taught me risk. My successes taught me patience. In finance, capital is easy to find. The true compounding asset is learning from every mistake you make." I really want you to let that sink in for a second. We spend so much time in our own careers stressing about compiling wins, but Vishnu proves that if you treat your failures as tuition fees, if you rigorously dissect what went wrong, that knowledge compounds faster and pays way higher dividends than any stock ever could. So I'm going to leave you with this question today. What is your true compounding asset? Are you letting your setbacks define you, or are you pulling out a blank notebook and writing down the exact lessons you need to fuel your next massive leap? Thank you so much for joining me on this explainer. Keep learning, keep analyzing those failures, and I'll catch you next time.